Hey guys, Freaky Finance here. Last week we looked at Crocs, and this week we're going to look at TKO. This is another fun one, and I kind of want to do it now that I finally have a 10K for the combined entity. Most people know wrestling, it's WWE, and most people know UFC. Showing you what the new company is, TKO, basically a combination of the two. So WWE with UFC. The economics of UFC are better than WWE. But the economics of UFC weren't always as good as they are today. One of the things these old owners have done with UFC is made it superior over time, and they're trying to do the same thing with WWE. So what I mean by how they made it better, for UFC they expanded base fan growth. AAV, we're going to go over that in a bit. It's a big part of why the business is priced like it is and why I think in the long run it's probably a good business. AAV is the average annual value. Basically, that's been going up pretty steadily for UFC. It's been going up for sports in general. And you can see here they've basically doubled growth for AAV since the IPO for international. They 3x the sponsorship revenue in about 6 years. They've also increased where they're going to UFC, so they're going to Abu Dhabi, Perth, more international places, money, which is also supporting the brand over time, allowing it to grow. We have seen the premiumization strategy that a lot of other companies have done. Right, 3x the VIP guests, so getting more per person when they actually have a live venue. And we have seen some cost savings. Now, in terms of the business, what's going to actually drive this company is going to be media rights. You can see that's 71% of UFC's revenue and 75% of WWE's revenue. You can see the split out to live events is very similar. However, I'd argue WWE did a worse job in sponsorship than UFC did. So I think what we're going to see over the next couple of years is an improvement on the sponsorship side for WWE, as well as continue to see media appreciate, just given the contract values of sports that we're seeing. We're going to go into that in a second too. And relative to other sports, this is probably one of the things that is different with UFC and WWE, that it's year-round, always on, so very steady repeat viewership. This is them on their 10K, which I was waiting for before I did this video. I've been looking at this company for a while, but it was always hard to get a real pulse on it just because there's so many moving pulses, and there still is for the purposes of today. So it'll be nice to see the 10K next year as well. Anyway, they claim that they have 700 million fans at the UFC, 260 million social followers, 900 million households, over 170 countries. So very big range. A lot of eyeballs. And then they have agreements with Disney, ESPN, ABC, NBC, Fox, BT Sport, Sony, Andy Rogers. Then they have sponsorships with Bush, Procter & Gamble, General Motors, Monster Energy, Jose Cuervo, DraftKings, right, Slim Jim, Wendy's. So across the board. How does the company make money? Really, there's 4 ways. We already kind of briefly talked about that with that pie chart, but the main one is media rights and content by a fair margin. So media rights and content, it's the licenses picture between like ESPN and UFC. It's just like that, just all over the world, the different people. And we've seen contract values steadily appreciate for live content, especially in these more recent years when we've seen the $1 trillion guys move in and start bidding up sports right. So that's your Amazon Prime offering, and Apple for their Apple TV, right? Apple for Major League Baseball. And we've seen Amazon start picking up a couple things. And we also saw YouTube, Google, another $1 trillion company, start picking up some stuff. So we're seeing the appreciation of sports rights. We're also seeing billionaires start buying more and more sports teams. So this is a trend, and I think it is going to continue. The other ones, live events, kind of what you think it is, live event in a certain specific area. That's like their actual sell the tickets, and you guys go. Sponsorship, so that's what you're thinking about, like the Jose Cuervo and Monster Energies of the world, just getting that brand advertising for the company. And they do have consumer products licensing as well. UFC does have video games and toys. I know WWE does have toys as well. They have Mattel. But yeah, so kind of the four business lines, with the critical one being media rights. This is according to their 10K. They expect to grow single-digit CAGR a year, but they say the streaming platforms, the Netflix, Amazons, and Apples, are expected to increase their content spend by 20% range over the same time frame. We'll jump into this more so when we go through the annuals. I just did them up, but you can see that the adjusted EBITDA margin is very high for UFC, talking almost 60%, whereas the WWE is about 43%. You'll also notice how much smaller WWE is versus UFC in terms of revenue and also in terms of EBITDA. So it's worth bring up, and again, you see this nice spread here between, you can definitely see what the main breadwinner is, right? Media rights. It's just the split out a different way if you want to freeze frame it. And I should say, I do own this one, so TKO right there. I just started at a smaller position. What I like to do is start these ones, and I'll talk about the end of the video about why I'm starting a smaller position, when I'm kind of hoping to get a cheaper price on this one. And I do think I'll be able to get it, but we'll see. So TKO, this is under 10K. You can see the UFC revenue just continues to go up slowly each year, 13% growth. They mentioned 76 more media. That's the higher media right fees that are slowly going higher every year. And they did have slightly more events and some more sponsorships, which all increased the revenue. The WWE side, I don't have the historical comp set, but you can see of the 383 million, 240, basically 250 million of that was media rights. So again, huge as well. And that's predominantly the WWE flagships. They did call out the Crown Jewel Premium Live event. It was also a good money generator for them for the year. There is some pressure on COGS. The UFC, we're seeing some competitors try to snipe fighters, which is kind of an interesting thing. It also tells you that how hot the product is, that people want to watch fights around the world, and it is relatively cheaper content to make for the amount of eyeballs you get. We are seeing content there, so that's starting to show up in the average salary for a fighter as it becomes more competitive. But so far, I mean, the margins are still very high. Like we're talking 58% for UFC, right? Around 60%. So very high. The negative, you can see the scale in the GMD is pretty strong over time, right? So there is something here. It looks like a strong business in the long run. And here you have the SGA though, and part of this is the WWE. So when that goes in, you should see this go up. But they also had quite a bit of one-time costs here, and you see that blow out between the net income and the adjusted EBITDA growth year over year. But mainly you can see they paid $94 million in professional fees or bonuses related to the transaction. They had $92 million in legal costs. They had $10.8 million restructuring on one side. I think they had another 10 on the WWE side, which they put in the COGS. But anyway, there's some one-time costs here, so it's worse than what you'd expect next year, which is kind of nice, by at least $100 million. Depreciation, amortization shot up. WWE actually spent more, it made less and spent more on its capex, so it was less capital efficient than UFC is, and you can see that here, shoots up $100 million. And it isn't small, right? Especially in the context that WWE is so much smaller than UFC, and it does have a floater, so we're seeing interest expense creep up, and it's at 8.4%. Ultimately, because early on, it's hard to tell a trend here to tell if I'm getting a long-term good deal or not relative to itself. And if I look at hard EV to EBITDA, it doesn't screen cheap. No, I say that when I own Uber, still at 35 times EV to EBITDA and Spotify and stuff like that, right? But it's not like I'm getting a screaming deal down here. It's just an interesting business that's growing well, and it's priced to grow. But relative to the estimates, I think the estimates are underestimating the value in the next 2 years. So that's why I'm kind of in my head, I'm like, I should probably be buying it. But I do think I'm going to get a better entry in this next little bit here. But we'll see if I do. Could be another Celsius where it goes up 80% on me in a couple weeks. Anyway, here you can see the balance sheet. It's pretty much all intangible assets, which is never a good sign. Ultimately, it doesn't matter when the business is growing. But when the growth stops or something bad happens, you're going to see impairments here. You almost always do. But so in terms of the balance sheet, it's not bad, but it's not great. They do have $235 million in cash, but they do have $2.7 billion in debt. Now relative to their cash flow, like even in this last year, they still put up $400 million in cash flow, so they could easily cover this debt if they needed to over time. So I don't view the debt load as overbearing or anything. And we should see, based on their guidance that they put here, like they're guiding to 1.16 billion in EBITDA, so going from 5, 6, 8 to 11 basically. So very strong EBITDA growth and free cash flow conversion at over 50%, which is pretty strong as well. It's definitely growing well, and that's not including the huge Netflix deal we'll talk about as well, which is in my eyes material and currently not being appreciated by the market. That's why I'm kind of hoping I can get in right before 2025. And we are seeing more and more sponsorship deals lately. In terms of the debt, this is just a snapshot because I just wanted to see what it was. And it's 2026 first lien term loan. secured overnight financing rate plus 2.5 or 2.75 to 3%. So they do have some covenants, but I mean, because the cash flow is so high and the debt's relatively low, it's not a need for concern right now, unless the business somehow got materially worse. But one of the things that is nice about contracts is that you actually do have steady, repeatable income that you can actually count on, as long as they don't have counterparty risk, which a lot of these big streamers don't. Netflix isn't exactly a counterparty risk. What else is there? Here's this knee, like, you can see all the stuff they're adding back. So one of the reasons why net income looked worse in 2023 and EBITDA kept growing is because of all the stuff they're adding back. Now, part of this is real. Like, interest expense did go up 100 million year over year, right? My depreciation is not a big deal to me, especially when capex 40 million a year. You have certain things that shouldn't repeat, right? Like 83 million in M&A costs, 34 million in legal costs, 21 million restructuring. By the nature, shouldn't be repeating every year. So that's at least, I don't know, 130 million that should be coming out next year. This is probably the biggest bull case for me in the long run, is just how much we're seeing the average or the annual average value of these contracts for sports just increase. Like, we're talking every time like they reset, this is up 78%, 181%, 19%, 38%, 215%, 258%. We're seeing these huge increases for pretty much every US sport, right? And even just these step ups, Big Ten, 2.7 times step up, 2.5 Formula One again, 16.6 times, right? Just crazy step ups, like we're talking 80% more or 110% more, right? So these streamers are just paying way more for sports contracts, rights, and it's ending up in these guys' pockets over time. And just for some context, right, this recent one, the big Netflix one, basically 5.2 billion, they're getting over 10 years. So this, just call it 500 million a year. Whereas this one was only 1.325 billion over 5 years, right? The old contract. And that just tells you how much they just appreciate it. And this is WWE's May contract, and you can see that here to the financials. Like I said, they only made 382 million, of which only 250 million was related to media rights. We know pretty much all that is from the NBC, and that's going to step up to be around 500 million a year just from this. So we should be basically seeing a double in WWE revenue as of January 1st, 2025 for 10 years, assuming it's successful, which it more than likely would be with Netflix flywheel and their ability to market around the world. So anyway, it's just worth bringing up the size of that contract to this business right here. And that should also improve the EBITDA margin, given they just basically making the same content, but they're just getting more money for it. So we should see margins improve for WWE as well in 2025. This is just, I was trying to show like the size difference. Like I said, you have one of the reasons why this trend is happening is the big multi-billion-dollar Netflixes and the trillion-dollar Google, trillion-dollar Apple, trillion-dollar Amazon are coming into the space and buying up sports rights. So it's adding more buyers into this market. Whereas before you really just had Disney, maybe WBD, and Paramount, CBS, right? Your ABC, your NBC, and your CBS. And now you got the big trillion-dollar guys coming in. They're pushing up the prices. Whether that's sustainable or not, don't know. Obviously, so far they're getting good returns on this because they're trying to get eyeballs to their streaming platforms. So we'll have to see how this works out. But I do think this trend is exciting, and there's a reason why they're paying what they're paying for these things right now. So this is probably one of the major narratives and the negatives for this current quarter. That's why I'm kind of looking at the video now, because I kind of want to get this if it sells off in April. And today's date is March 14th, 2024. So you can see Vince McMahon has been selling quite a bit of securities at around $77, and I think this is going to be continuing. Some of the existing team were trying to buy to outweigh it. They also use some of the company's cash on hand to absorb some of the share count that's coming online. But Vince McMahon had about 28% or 25% of the business, and he's been constantly selling ever since these allegations have come up. You can see at this is before the latest sale. As of December 31st, he's still at 24.7% of the business in Class A common stock, which is what you and I would own, right? But what's happening, this is as in January, right around the time actually of the big Netflix deal. Basically, he's getting accused of sex trafficking. And if you actually read some of the stuff that's brought up by this lady, it's pretty crazy. It sounds like he has a history of it. Anyway, regardless of what going to happen. Usually what happens is the media will run with this and make a lot of negative headlines. And so at the hearing that starts in April, I'm expecting more and more journalistic headlines to come out slamming Vince McMahon, who's still affiliated with this company indirectly, right? Because he is trying. And I do think it's like long term, it's not much of the company, but in the short term, it just adds more selling pressure. At the same time, you can get a momentum thing here with a lot of negative headlines about him, which could lead to an even better entry because the narratives in the short run really drive share prices more than people appreciate, or at least that's what I've learned over the last decade. So it's not near the end of the Bollinger Band yet to get super excited anyway. Right now, that would be around 73. And this thing doesn't have a valuation backstop really. Like I expect people to come in around 15 times no matter what for this thing, but it could get cheaper, right? That's what I'm trying to say. Based on those headlines, there's a lot of short interest, so obviously my thinking there is in the loan. People are already in this, 13%, increasing 1% more this week. There's some other on the positive, so I'm going to go back and forth from positive and negatives here. On the positive though, you also have UFC coming up as well again. And the last UFC was I think it was a triple or a double more than the time before. UFC 100 to 470, 370% for the last 6 years. So I don't know if it's going to jump up like that again, but you should see again more appreciation on that contract renewal. But at the same time, he's basically saying our preference is with Disney, so ESPN again, because of history. But we've had 3 different platforms inquire about that window you're talking about. So you can see there's a lot of people wanting to buy the content that TKO produces, and UFC and WWE produce. And I just think like when you have Amazon and Apple and Netflix coming in, the pocketbooks are a lot bigger. And at the same time, like right now, we're seeing all-time high records, right? All-time records, Madison Square Garden, cementing first, second, and third time all-time grossing events. Fight Night in Austin, Texas, highest grossing sporting event ever at Moody Center, right? These are ever. So we're seeing more and more popularity for this. It's not like it's at the end of a momentum run. It's still building. And we are seeing more and more hype for WWE as well lately, which is surprising. Kind of made a little bit of a resurgence, I think. The negative again, first quarter 24, actually have less events compared to last year. So they only have 3 numbered events compared to 4 in the prior year, right? So that'd be a hit, less events, less traction. And they also say they're going to expect 5 events with live audiences compared to 6 in the first quarter of 2023. And they also have absence of consumer products licensing revenue that was recorded in Q1 23. So they have basically some harder comps in this first quarter as well, which I still have to report. And maybe that's priced in, maybe it's not. But I don't have like that urge to step in here and be a hero, especially with the Vince McMahon overhang. And so when the plaintiff is on the stand, you're going to see a lot of stuff get dragged through the mud. And I think the reason why Vince is selling right now is because he's trying to get out and separate from the business. And this could be also TKO telling him to get out. I don't know. Right now, this is conjecture. But, I mean, there's no coincidence here that it's trying to get out, right? These aren't small amounts like he was at 27. And here you can see is at the latest analyst conference call, cut holdings to 15 million shares. He had sold an even bigger tranche several weeks ago and positioned his company is now down from an initial level of 28 million shares, giving him 8.5% of all shares. We are not in conversations with McMahon. We don't know his motives, his plans, or his timeline. He doesn't work for the company, doesn't come into the office, and is not coming back to the company. And that's where we sit. I think that's very important, and is not coming back to the company. So they're definitely trying to separate from him before shit hits the fan. And then on the positive, you have Dwayne Johnson joining the board. So you have basically getting the top. Dwayne Johnson's probably the polar opposite of Vince McMahon, right? In terms of social network strength. And what's likely going to be hate on Vince, and Dwayne's been like man of the year and stuff like that, right? So anyway, you're seeing them clean up everything. But right now we still have that little overlap where you have to get rid of the old, bring in the better. And I don't know how the market's going to treat that because it seems to overreact to whatever's currently happening. And so currently I'm expecting a hard Q1 into this Vince McMahon drama, into some more selling probably, which could lead to a better entry for someone like me who's waiting for it, because I think longer term, especially in the back half of this year, right into 2025, this thing's probably mispriced. And when I look at the analyst expectations for 2025 and even the back half of this year, I just think they're too weak. They don't even think they're gonna beat like 2022 or 21, right? And I didn't even talk about the synergies that they're getting off this deal. But I did talk about the one-off charges they've already incurred. So we should see synergies and the one-off charges incurred go away. While at the same time, you have these nice steady appreciations on the media rights into a brand that's hot. While the people who are buying the media rights are still flush with a lot of cash. And are still trying to get eyeballs to their platforms to get engagement, and having sports every week consistently is probably the top engagement you can have. So anyway, I'd like to know your thoughts. It's a fun one. Again, I'm trying to get cute with the entry. I'm hoping for more weakness as some headlines hit inevitably from this trial. But yeah, have a great rest of your weekend.